Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 13th of May. It comes off the back of a week that really has been dominated by central banks, with the RBA and the Bank of England opting to keep rates steady as expected. But we did see the week end with a flourish as UK GDP came out at 0.6% for the first quarter. Big outperformance and an exit from the recessionary environment that has dominated the prior two quarters. The question mark here is, are we seeing enough from the UK economy to push back expectations for Bank of England easing in the coming months? Well, we'll get into the UK outlook, but first and foremost, let's look at the big picture in terms of some of the main events over the course of this week. So Tuesday, we have got the UK jobs report alongside the ZEW economic sentiment figure out of Germany. We've got the US PPI inflation number coming out on Tuesday, but the big ticket item really is on Wednesday, with the inflation sort of CPI number coming out alongside that retail sales number. So the the US is really going to be at the forefront of investors' mindsets. Also looking towards the back end of the week, we've got a Asian focus with GDP coming out of Japan. We've got that building permits number out of the US, but then we've got a whole raft of data coming out of China with the likes of industrial production and retail sales to contend with. The first area we're going to look at, of course, is the US, with that PPI number coming out on Tuesday. Expectations that we're going to see that come in around about 0.2%. But really, the big ticket item is going to be the Wednesday inflation report. Expectations that we're going to see both the headline and the core reading coming at 0.3% for the month. But if you look at where things stand on the year-on-year metrics, 3.5 expected once again for the headline number, 3.7, a tick lower for that core inflation metric. I have produced a sort of wider deep dive into the inflation picture for the US and highlighted exactly why I wouldn't be too confident if I was looking for a September rate cut, which is currently what is being priced by the markets. Inflation doesn't look like it's going away. And ultimately, we've spent the best part of a year seeing US inflation treading water around the mid 3%. The last few months have seen bumper month-on-month gains for inflation. Bear in mind, we need to see inflation below 0.2% on a monthly basis to get back down to target. Well, we're expecting it to drop to 0.3% this time, but even that's still above what is needed to get back down to 2%. So this could serve as a timely reminder that ultimately the US inflation picture is likely to remain elevated and above target for an extended period of time. And then the question mark comes about, are we going to see the Federal Reserve ultimately cut rates ahead of time and before inflation returns to target? Or are we going to see them change that target? Or more likely, do they have to continue to push back the timing of that first interest rate cut? If we did see that, of course, you'd be looking for potential risk off play, but also US dollar strength. And so the first market I wanted to bring to your attention is euro dollar. So euro dollar, we can see here, has been gaining ground. We've seen, if I overlay the likes of the US 10-year, the gains that we've been seeing in terms of the 10-year largely reflected in it with an inverse correlation against the likes of the euro dollar pair. So let's say, for instance, we see flare up in inflation, or we see above target inflation once again. You're looking for a potential rebound in terms of that 10-year. That would point towards a potential rolling over for the likes of euro dollar. I can highlight it here by inverting this so you can see it exactly. So ultimately, all of these markets generally have got correlations, and the underlying correlation for many of them comes down to the likes of the 10-year yield and ultimately inflation expectations. And inflation, if we see it rear its head, or if we see markets realize that perhaps September might come too soon too, then you're looking at the possibility of another surge in terms of treasury yields, and that would likely drive euro dollar lower once again. So we have got, or for me, I've got a bearish bias for this market because I don't think that we're going to see a return to target anytime soon. And that September rate cut with 2 rate cuts this year may still be too optimistic. So I'm erring on the side of caution and expecting to see the dollar coming back into strength soon enough. So just seeing if we've got sort of trend line resistance coming into play here. So we do. So we're back at trend line resistance. Notably, we've got a downtrend for euro dollar. So essentially an uptrend for US dollar here. Playing out over 2024 thus far. We have been regaining ground, but we've come back into trendline resistance. And also this rally, to me, just looks like a retracement before the bears come back into place. So where are we from a fib perspective? Well, we're approaching that 76.4 fib once again, or we have tagged it. We're now, because we're back at this trendline resistance, you could say, well, we might not actually get into the 76.4 fib. So we're between those two deeper Fibonacci levels. We've rallied into it on Thursday, Friday, treading water somewhat. I wouldn't be surprised to see this market roll over soon enough. For the near term, if we did see a pop-up through trendline resistance, you would be looking out for that 76.4 fib, which is around about 1082. But ultimately, unless we see that break through 10885, then the current rally looks like a potential precursor to the bears coming back into play. And certainly if we see inflation flatlining as expected, I don't even necessarily think that we need to see something too out of the ordinary in terms of really high inflation this time around to warn markets that we might not see a rate cut in September. But if we do see a reading above 0.3% in the inflation number, then again, that would likely drive this pair lower. We'd need to see a significant move lower in terms of inflation. If we saw a 0.2 or lower on a monthly reading, maybe that gives us a little bit further upside for this market. But I think there's significant risk that the bearish trend that's been dominating this year comes back into play when we see some of this inflation data coming out over the course of the next week. Looking at the next area of focus, it is the UK. We've got the jobs market coming into the limelight on Tuesday. Unemployment expected to remain at 4.2%. Average earnings expected to tick lower to 5.5%. The employment change expected to come in at a minus 210K figure. Ultimately, the question mark here is what's going to move the dial. I would say there's going to be a focus on the average earnings. We have just seen this very strong GDP report coming out of the UK. And ultimately, that points towards a possibility that the Bank of England could hold off. So if we see signs of economic weakness to undermine that theory, then that would be notable and a potential boost for the FTSE 100. Also, if we see any significant disinflation in terms of the wage numbers, so we're expecting to see both the average earnings, including and excluding bonuses, move 0.1% lower. If we see any more significant move lower, then that could also light a fire under the FTSE. But what's notable is that despite, like I said, we've got this sort of rhetoric around, massive GDP, beat, that means that the Bank of England could hold off, and therefore we're seeing strength in terms of the pound. What happened to the FTSE 100? Just hit another record high. And that just highlights the mood that this index is in at the moment. And so, ultimately, for me, I say it all the time, the job of the trader is to find the most convincing market and the most reliable market. And this, at the moment, is one of the most reliable markets out there. You can see here on the daily time frame. Over the course of the past, over a month now, we've seen, 2 down days that were pretty marginal. This might have been one, so maybe 3 down days over the course of a month. So every day, it seems like at the moment we're hitting record highs for the FTSE 100. That provides the basis for a trading environment that people can get on board with. And, if we start to break out from that trend, then, you've got a warning signal there that perhaps it's not going to continue, or perhaps you have a wider retracement coming into play. But, ultimately, we're seeing very steep gains, as you can see from these ascending trend lines. If you're looking at sort of short-term price action, you can see here on the 15-minute chart just how it's playing out. And we are getting these nice little retracements, lovely little trend playing out here on the bottom end with the creation of higher lows time and time again. And so, if we start to break back below your near-term swing low, that, I'm having to highlight this on a 15-minute chart because of the fact that we're just not really seeing much by way of decent pullbacks. But if we start breaking below the 83.65 mark, then you're perhaps going to see a wider retracement coming into play. But until that happens, I think there's a good chance that we do see this trend continue once again, which signals the idea that pullbacks are there to potentially be bought into by people that are bullish of this market. Ultimately, I'm looking at a market that is devoid of any resistance. It's hitting record highs on a daily basis. It's pretty much up every single day over the course of the past month and a bit. And therefore, I'm looking at this with a positive mindset unless we see a breakdown through your key support. At the moment, that's 83.81 and 83.65. So, yeah, this is a really interesting market at the moment. And you know, the fact of the matter is that these markets don't necessarily continue in the same trajectory forevermore. You know, not so long ago, we were talking about gold just going up every single day. And then suddenly we see it crashing back down and everyone says, you know, I told you so, it was overbought. But ultimately, the market can remain overbought for an extended period of time. And within that period, you can take plenty of trades over that time frame. So, you know, if I was to bring in, say, the RSI right now, this is probably going to be heavily overbought. Does that mean that it's suddenly going to reverse? No, it doesn't, because the RSI is a lagging indicator. It follows price. So price leads everything, and this price continues to push higher. So this is a really good market to be looking at the moment as things stand. And then finally, I wanted to bring up the topic of the Japanese economy. We have got some notable data coming out. We've got inflation on a PPI front coming out on Tuesday. We have got machine tool orders on Wednesday. The key thing here is going to be the GDP number coming out on Thursday. Friday, we've got industrial production as well, which is expected to sort of bump higher, but that is a final reading. But you're looking here, you know, what are we looking for? Q1 GDP 0.1% expected, not necessarily going to knock anyone's socks off. But why is this important right now? Well, what's happening at the moment is that the Japanese yen continues to be hit hard, and you're seeing near enough daily comments coming from the BOJ warning about possible further intervention. Now, it's a costly task intervening in the way that they have, and arguably it comes to no avail, because if you look over the years, the BOJ have intervened on a number of occasions. Sometimes they spark a 1 or 2 day pullback for a currency pair trading against the Japanese yen. Sometimes it might spark a week-long reversal of that trend, but generally that trend does continue. And certainly what you want to be looking for here is currencies where the country in question still has inflation pressures to deal with. And I would say the US is key amongst those at the moment. You know, much in the same way that I'm talking about the possibility of euro dollar rolling over, the Japanese yen against the US dollar still remains within a bull trend despite recent intervention. Now, this is, of course, one of those currency pairs where you have to be careful, because you are talking about the possibility of left field intervention that might spark volatility in the opposite direction. But like I said, in the past, they've tried to protect levels and they haven't managed to do so. Excuse me. And those levels have ultimately been pushed further and further. Well, where can you see that the recent intervention took place? You can see 160 was protected. So we're now back up to 155. You know, maybe they protect the 155 mark. Maybe we rally up to the 160 mark. But this is certainly one of those markets that you don't necessarily want to be trading over a weekend, because you might see some sort of movement over the weekend and you might see a gap. You want to be looking for trades where you're implementing good risk strategies, so minimizing your risk by setting your stop losses. You don't want to be sort of following this and just getting out of the trade based on you know, your gut feeling, because this is the kind of thing that suddenly you can get intervention and the market moves very swiftly. You can see here, these are the two recent intervention moves from the BOJ. So firstly, you can see around that 160 mark, then that sharp collapse back down to 155. Notably, that came off the back of the BOJ meeting where they essentially saw it go from 155 to 160. So it was a very costly 24-hour period. Well, I say 24-hour, it did take place over Friday and into the Monday. but 24 hours in the market sense. And then we saw it once again here. So we rallied back up to the 158 mark and then collapsed back into your sort of 153s. Well, where are we now? We're back up to 155 and gradually climbing. I think there's a good chance that we do see further upside coming into play. I think the dollar strength story is not going to go away given the problems the US is going to face in terms of inflation. And look, what we generally see is that we see this flash lower and then a gradual regaining of ground, the flash lower and a gradual regaining of ground. So there's different ways to play this. I mean, one way would be to say, hey, I think that we're going to see more intervention coming into play. I'll let this rally up into your 158, 160, wherever. Wait for the intervention to happen. Wait for the market to settle because you see that initial volatility. And then once it starts rebuilding, then you can look to get on board that move. That's one way of playing it. And if you have done it from the lows down here, you know, once you see it flashes lower, you know, you see that initial volatility, then you see it selling off. Once you see that bottoming out pattern, you've been able to take advantage of this rally. You know, you could maybe see a similar kind of thing happening in the future. Alternatively, some people will be riding it back up because they're thinking, well, 158, 160, that's where we saw intervention previously. So different ways to look at this. Stop losses are going to be key. You don't necessarily want to be trading this market during periods where the market's closed, so over weekends and the like, because you don't want to see gaps and slippage from that perspective. But certainly a really interesting one at the moment because you're seeing a market that essentially is one directional, right? In terms of like the long-term trend is very bullish. Even when you see the BOJ intervening, the market wants to move higher once again, but you have the fear of further intervention. But that intervention can bring opportunities for markets. So whichever way you play it, this is going to be a really interesting one to follow over the course of the next week. We have got GDP data, but arguably just waiting for certain levels to be hit and looking for further intervention from the BOJ and then looking for the market move after that as well. That's going to be just as important, and especially on a week that has got, of course, the latest inflation data coming out of the US. Thanks for watching. I hope this has been useful. It's going to be an interesting week for traders. We're looking at the back end of earnings season as well. I've provided a preview for that with the likes of Walmart in particular, but also Home Depot and Alibaba. So make sure to check out that video alongside the deep dive on the US CPI that I provided on the Scope Markets channel. Have a great weekend and have a great new week's trading. Thanks a lot.